Hello, everyone. We're going to give it another few seconds for people to trickle in, and then we will get started. Okay. Welcome, everyone, to this office hours on all the legal aspects of buying a business. Today's topic, cap tables. My name is Will Smith, and I'm the host of the podcast Acquiring Minds. Attorneys James David Williams and Bill Barlow are going to host this session, their fifth office hours with Acquiring Minds. These are very popular sessions. Over 700 people registered for today's office hours. James David and Bill are partners in Barlow & Williams, a practice that specializes in small business acquisitions. So they're out in the trenches seeing tons of deals, and their focus is on helping searchers, sponsors like you all, execute deals while protecting your downside. They also represent sellers, so they understand well both sides of the table of the transaction. I'm going to hand it over to them in just a sec, but a couple of housekeeping notes. The way this will work is Bill and James David have a presentation to give, Cap Tables 101, how capital structure works when buying a business. That'll go for about 20 minutes or so. But as always in these office hours, the idea is to leave ample time for all of you to get your questions answered. And as always, questions don't have to be about this presentation, don't have to be about cap tables. Really, any legal questions are fair game. That is what James, David, and Bill are here to help you with. So to ask a question, use the Q&A function of Zoom. You should see a Q&A button there. And note that sometimes in these office hours, we get pretty complex questions, often from somebody who's actually working on a deal and has a very, very specific issue they're dealing with. And those aren't always the best for the office hours, but Bill and James David can reach out to you after the fact with help on that question. So if you think you're somebody with that question, make sure you're not logged in anonymously, because if you came anonymously, they can't reach out. And so don't be anonymous, and do ask the question so that we have a record of it, and then they can follow up with you. Even if it doesn't get asked here live, it's a way of ensuring that Bill and James David will reach out after the fact. The session's being recorded, and you all will receive a link to that recording soon. And then finally, check your chat here, posting in a bunch of links. The socials for James, David, and Bill, connect with them on LinkedIn. Their email addresses are also there. And then the 4 previous office hours that they've done over the last few months here with Acquiring Minds. Amazing content in all of these office hours. So if you missed any of those, go back and watch them. I think that's it. James, David, Bill, over to you guys.
It's good. Well, thanks everyone for attending our office hours today. Hopefully we can be helpful for you. Just a brief overview of us. This is the firm, Barlow & Williams. We're the 2 partners. We've been doing this for a number of years. We're an M&A boutique, and we'll talk a little bit at the end, a little bit more about us. In terms of this actual presentation, our focus is going to be on cap tables. So this basically is who owns what in a company. So a lot of traditional searchers will, or I should say self-funded searchers, will go out, use their own money, SBA debt, buy a business, own it 100% their own, and that can be wonderful. That can be a great model. Then you don't really have to worry about a lot of the things that we talk about here, although you may still want to pay attention. However, there are many situations where you might want other people to own parts of the company. So maybe you have a partner, you and your search partner are searching together. Maybe you're bringing on investors. Maybe you want the seller to continue to have some ownership in the deal. Maybe you have employees, you want to incentivize them by giving them some equity, some upside. And so what we're doing here in this office hours is focusing on those situations. What are the common situations, and what are the sort of market terms we're seeing out there for these type of situations? So with that, I'll pass it off to James David to start us off.
Yeah, thank you, Bill. Let me see. There we go. So the first thing I'm going to talk about is search partners. So what we mean by search partners here is, say you and one of your friends or a business colleague, or I could be a spouse sometimes too in these transactions. So there are two of you who are doing the search together. So the first issue is going to be ownership percentage. And you would think this would be straightforward, but it's not always, right? There can be reasons that one person needs to own a majority of the business, certain designations that require majority ownership by particular people. Could also be in certain situations, somebody who holds a license that requires that. But it's also, the ownership percentage can be very important in terms of the personal guarantee if you're using SBA financing. All right, so anybody who's at this time 20% equity holder has to sign the personal guarantee. A lot of times when people kind of do a partnered search, they don't want to both be personally guaranteeing the loan. There are ways to handle that and maintain compliance with the SBA, but there can be some complexity around that. There are also people who kind of blow through things and technically violate their terms of their SBA loan. I don't recommend doing that, but there are ways to structure it so that you can legally own 8119, but still get the economics that you want. The next issue is vesting, which probably less applicable in a kind of self-funded search model where you're getting all the equity at once, but potentially you have partners who are putting in different amounts of money, or one partner is really going to be doing sweat equity, one partner is the financial partner, right? So for that person doing sweat equity, often that their equity is going to be subject to vesting, meaning it's earned conditioned on certain things happening. There are kind of two common forms of vesting. One is time-based vesting, which is you continue to work for the company for this many years, and so you get tranches of equity. And then there's performance-based vesting, where you get equity in exchange for hitting certain revenue thresholds, or whatever other metric you choose to use. If you are doing vesting for equity, there can be some tax complications around at the beginning, some things you need to do, something called an 83B election in certain circumstances that you need to file. But somebody who's helping you set this up can figure that out, help you figure that out. Probably now we get to the really important things, governance issues. So if you do have a two-person partnership doing the search, as is most common, everything works great until it doesn't, right? So you need a way to decide, one, what requires both of you to agree to, right? Because often things like issuing new equity or buying, selling the company, those sort of big decisions often require both people, regardless of their ownership percentage. Not always, but commonly. And then the buyout right is really like, what happens if you two just you fight and it needs to dissolve, right? In many ways, the purpose of an operating agreement is as a prenuptial agreement, in case you do need a business divorce later, right? And it's best to have a mechanism in there of, okay, how do we unwind this if one of us needs to leave or wants to leave, or we just can't make this work anymore. Because if you don't agree to it at the start, you're probably going to end up in litigation at the end, and then you're just spending money on legal fees. And I'm not a litigator anymore, so I don't get those legal fees. So I don't want that to happen to you. And it just gets messy, right? So there are very, there are a few options for the buyout rights. It can be based on a metric pre-agreed. You can do something called a shotgun option, which is one of my favorites, where one person sets the price and it becomes a buy-sell option. It's a little bit complex, but I like the name of it. And then sometimes, they'll have people will do a third party, right? Have a CPA firm do a third party valuation. Would be another common dispute resolution mechanism for a buyout.
All right. Now we're going to move on to the next portion, which is taking on investors. So it might be the case that you found a target company, you're really interested in buying it, but you do not have enough capital yourself in order to buy it out. And in many cases, that's the plan all along. You know that going into it, you're looking for a target that's, a little bit bigger, and your plan is to bring on some extra equity investors in order to help close the gap. And so there's a couple terms that are usually used in the business that we want to introduce these to you so that you can more easily communicate when you're talking to investors what they're going to get out of it, and so that you understand, if you do choose to bring on investors, what effect is that going to have on your distributions and how much you get back. I'm also just going to mention for a second, there's a difference between family and friends and true third-party investors, right? Family and friends are people that might believe in you, like you. Maybe they just invest money alongside you, just get some common equity with you, and they're happy because they believe in you, they trust you, all of that good stuff. So, you tend to get friendlier terms with that. What we're going to talk about today applies somewhat to that, but a lot of it applies to kind of third-party investors. So these might be family offices, high net worth individuals, people you don't have a pre-existing relationship with necessarily, but who are looking for a good return. So they're not going to just invest in you just because they like you. They're investing in you because they believe in the deal and they like the economics. So when you are talking with these investors, these potential investors, there's a couple of concepts you're going to need to know. Probably one of the biggest ones is a step up. So what a step up means is, let's say that you are looking to acquire a business for $10 million, to make it simple. And let's say you are looking for an investor to put in $1 million in equity in order to help you buy this business, right? You might think, okay, $1 million, $10 million enterprise value, it becomes, I'll give them 10% of the equity. But a step up says, no, you actually are going to give the investor more. So they put in $1 million in this case, they're putting in 10% of the entire deal value, but they're actually getting 20% of the equity. And that would be a 2x step up is kind of the terminology. And you might ask, why does this happen? Why is this fair? Well, keep in mind that you're using debt almost always to buy, at least half of the company. And so, that equity check might be like 20%, even less of the actual equity check or even more of the actual equity check that's coming in. So this is something that's subject to negotiation and is a really big issue for investors, is how much step up am I going to get? It's a very frequent question you'll be asked. Another term you should know is preferred return and liquidation preference. So just so you know, with family and friends, they might invest and just get common and get the same distributions as you. Third-party investors generally don't invest that way. They will require a preferred shares. And how that works I'll just use the same example from before, is if they invest their $1 million into your $10 million deal, they might say, I want a 10% preferred return, I want a liquidation preference, and I want a 2x step up in basis. And what that means is, let's say that, you know, the business goes along for a couple of years and there's an exit. How the waterfall of money works is, first, before any money goes out to you or anyone else, I mean, first you pay down the debt and expenses, then you give them their preferred return, then you return all of their capital to them. So that $1 million they initially put in, they get that $1 million back. And then finally, it's a distribution out to everybody. And that's where the step up comes into play. And so in general, they're going to get a preferred return. They're going to get the liquidation preference, i.e. they get their money back before you get any money. And then finally, they're gonna you know, continue to get the upside in the waterfall. This can be complicated. There might be questions on this, and we're happy to run through this, but we also don't want to make it too complicated for the purpose of the webinar. This is just to kind of introduce you to some of these concepts. And then we can get to the next slide. So what we just talked about are kind of the more economic issues. We also need to talk about some of the not quite economic issues, more governance issues, just like, you know, before when we talked about with our partners. So one thing, I'll actually be the second point. This is a economic issue, is sometimes investors want a put right, which basically means that, you know, you might buy a business and be so super happy to hold the business for 20 to 30 years. Investors typically have a shorter time horizon, or a specific time horizon. Often it's like 5 to 7 years. And so the investor might say, look, you might love this business, that might be great, but I need the ability to get out of my investment at the 5 to 7 year mark. And if you sell the business, great, everything's wonderful. But if you don't, I need to be able to sell my equity to you so that I can get my money back, so that I can do these things. I can get liquidity. And so this can be a point of discussion and negotiation, because you need to determine what that right is, and like what the valuation is, and when it's triggered, and all of those good things. So that kind of goes to the point of the put right. The other things that you might want, first of all, governance is often a big issue. So oftentimes investors will say, look, I want to make sure that the company has a board, and I want the investors to have a board seat, or sometimes a majority of the board seats of the company. And that gives us control to make sure that you're running the company properly. They might also ask for veto rights, like, you know, there is sensitivity. They don't want you to be paying yourself a huge salary, right? Like you have a company that's producing $1 million in EBITDA. Well, if you give yourself $1 million salary, then you've taken out all the value for yourself, and they're not getting anything because that salary does not count for distributions. And so they often want caps on that. You know, there might be certain areas where they're sensitive about, you know, you can't do certain things without their consent. And again, that's an area of negotiation. If you're the searcher, you want maximum flexibility. You know, if you are the investor, you don't necessarily want maximum control. You don't want the searcher to come back to you for everything, but you do have kind of a list of things where, hey, I want us to sign off on this before you go out and do this, you know. And then the other thing is, you know, if you have third-party institutional investors, sometimes your equity is subject to vesting, just as with before. You know, they will, there's various things that they do, but sometimes they say, look, I want to incentivize you to do really well. If you give me a great IRR, a great MOIC, then wonderful, you get more equity. But if you don't, you know, I'm hurting, and so you get less upside. So those are things that we've seen as well. there's a lot of other terms, there's a lot of other things to consider. And you know, we've just sort of scratched the surface here. But hopefully this at least helps you navigate some of the big picture issues that you'll be dealing with when you're, you know, looking to potentially raise money on a search.
Okay, so now we're going to turn to rollover equity. So what a rollover means is that the seller is going to maintain equity. So that's the roll portion of this. And this is now much more common than it was after the partial buyout rules that the SBA put out last year. So there, you know, you have a lot of the same issues as with investors around, you know, certain sellers may want certain control rights or you know, they may want to maintain a board seat. They may want to keep veto over certain decisions. But there's also some things that are unique to sellers. One, it's probably not that common, but an earn-in structure. You know, everybody's heard of earn-outs where the seller gets more money based on performance after close, but there can also be such a thing as an earn-in where the seller, you know, gets equity in the deal, it gets equity in the business for, you know, continuing to work in the business post-acquisition. Probably not that common in an SBA deals, given some of the percentage limitations that are allowed in those structures, but it is a thing in larger deals. Excuse me. Second thing is sort of around it. If you are doing a true roll-up, if you are implementing a roll-up strategy, there can be, and you are, as part of that, giving the seller an equity roll. Right there, there's a few different ways to do that. So if you had the roll-up as a, we'll just do it as a holdco. So you have a parent entity and subsidiaries, and you know, each acquisition is a subsidiary. So it would be possible that each seller would get equity in that, you know, his own or her own subsidiary. It's also possible that each seller would get equity at the parent level. That can create different incentives for different people, and the economics can look very different. It needs to be kind of pretty well thought out in advance, hopefully. But there are options there as to where that equity actually goes. And then just an issue that really shouldn't come up as often as it does, but in many ways, the purpose of the rollover equity is to reduce the tax burden for sellers as part of the transaction. If the rollover is done properly, then it is not a taxable event, and so the seller is not paying taxes on that portion of the business of the sale. But the transaction does have to be structured correctly for that to happen, and sometimes it adds a little bit of complexity, but it's very important, because if you don't do it correctly, then the seller may have to pay, you know, capital gains taxes on, you know, that extra 10%, 20% that they're supposed to roll, but they're not getting any cash as part of the transaction to pay that. So if you get that wrong, it's a really good way to make a seller very angry. And if you're doing a rollover, you really don't want that, because the seller's staying in the business. So like, make sure that things are structured so that if at all possible, it's what's called a tax-free roll.
All right. And this part, even if you are going to do a completely self-funded search, you may still be interested here, because you may still have, you know, employees you want to incentivize. And so, you know, this isn't particularly unique to searcher deals, but it's certainly something you should be aware of, and something you may need to structure in advance, especially if you're taking investor money. You will often need to set up your structure so that you can give employee equity kind of from the outset, and make sure that you're prepared to do that. So we're not going to get into all of the technical mechanics here, but when you have employees, there's a number of different options that you have in order to give them effectively equity upside. Options are fairly common when you have a company that is already sort of, up and running, which most times that's going to be the case. Again, there are specific tax things you have to do in order to make sure that this doesn't become taxable to the employee. And we're happy to kind of walk you through that at, once you get to that phase of your transaction. There's also something called phantom equity. Basically what this is it's you are promising to pay the employee a certain amount of the proceeds of a sale. This phantom equity, which you'll also potentially see, by the way, if you're buying a business, you might say that the seller says, hey, I promised this person who's been working with me that I'm going to give them 1% of the proceeds when we have a sale. Like, I've made that handshake agreement, I want to do that. That's phantom equity. Phantom equity is not great for the employee for two reasons. One, it's quite easy to lose it depending on how the deal is structured. We've dealt with employees that have phantom equity, and even though there's a sale, because of how the sale structure works, they get nothing and it's not triggered. And it's also going to be ordinary income because it's not equity, it's just a bonus payment. So they're taxed at ordinary income. They don't get capital gains if you structure it that way. So it's quite tax disadvantageous to the seller, to the employee to have phantom equity. Not to say it doesn't happen, but you should just kind of keep that in mind. Vesting, again, you don't necessarily want to give somebody shares under the idea they're going to be working for you for 4 years, and then they walk out the next week and boom, they still have all those shares, right? That's not a good situation. So vesting is essentially a process by which the employee, usually after time, but it can also be based on performance metrics, earns that whatever shares that they have, and then once that milestone has been reached or that time has been reached, then they earn that equity and they've truly earned it. Just so you know, in general, when employees get equity, they get non-voting shares. And usually in the operating agreement, there's like a separate class. And that way, basically they don't have governance rights. They can't suddenly decide to get upset and stop the process or hinder the process or anything like that. They get the economic benefits, but in general, they don't get any of the governance rights that you would see the other classes get. They're just sort of along for the ride.
All right. Fewer slides this month than last month. So that's the end of the presentation. Very quick sort of fire hydrant overview. We probably threw a lot of terms. I know there were some acronyms in there that people may not have seen before. But that was meant to be a quick overview of kind of some of the bigger issues around cap tables and structuring. And when we say cap tables and structuring, what we really mean is post-acquisition. What does the cap table look like? Probably should have said that from the top. If any of this has piqued your interest, you want to talk to us, you can feel free to email us here. I think Will's put our contact information in the chat. As we said at the top, all we do is mergers and acquisitions. We work with buyers, we work with sellers, we work with investors too. Right? So we see all sides of these deals. And we work on flat fees, so we are different than a lot of traditional law firms. Happy to talk more about that. But it does make it to where our goal is to provide value to our clients. We're not here to just churn the clock, churn hours, right? We're here to get deals done, and that's what we pride ourselves on doing. So again, thank you, and we'll hand it over to Will and start moderating. I see there's 30-something questions already. So
great presentation as always, guys. Really, really helpful and clearly a good starting point for Q&A from the audience. Couple people have asked what I was going to ask. Is the cap table an abstraction, or is there something that we can see? This looks like a cap table. Is it basically just a list of who owns equity in the business?
yeah,
People are saying, can you show me a cap table, please?
So there are software tools that help people manage this. I'm not going to name them because I don't do free ads, but Often it's just an Excel spreadsheet, frankly, right? Initially, as part of the operating agreement or shareholder agreement, it's common to have a table of this person owns, this many units or shares, and it amounts to this percentage. But in terms of sort of ongoing, and it's good practice whenever there are changes to update that table. But frankly, most people keep track of this in an Excel spreadsheet. And it would just say, name, type of, one column will be name, and type of unit or share, number, and then probably a percentage of total ownership would be a common way it looks like.
And that's
James,
also, you want to keep all of the documents you executed, because that way, if there's ever any dispute about who owns what, it goes back to the signed document. So that's why it's so important to keep those, for your file, so you can reconstruct that if there's ever a dispute.
James David, I heard you say there are tools, and then I got distracted by the questions. Did you name any of those tools?
I didn't.
He's being coy.
Yeah, no,
Oh.
I think Carta is the biggest one, probably the most common, more famous in startup land than in searcher or sponsor land. You could use a tool like that, but many of the functionalities you don't really need. So,
Okay. But for
it-
reference, everyone, that's Carta with a C. You might just nose around, and just probably browsing the website could be a bit of an education, even if you don't choose to use the tool. But
Yeah.
that is kind of made with startup land, startups in mind.
Yeah,
as opposed
that's
to what we're
for
doing here.
startups, and that means C corps, and they deal with 409As and issuing options and following all of that, and often these searcher or sponsor deals are, completely different corporate structures. So
Yeah. Okay. Let's see here, guys. Going back to, can you go back to the investor? I think maybe the way to try to organize the many questions, we're almost at 50 now, is sequentially here, aligned with the presentation itself. Investors, what are you seeing out there in terms of industry norms or standards around some of these numbers, namely liquidation, the pref rate and step up?
yeah, I'll just say I don't like liquidation preference. Like, that's a startup term that I don't want to come into this world. It's a
Oh.
venture capital term that I don't really. We've seen it a few times, and that's why it's here. But it's a venture capital term that I would personally like to keep out of these. But that's just me. On the preferred return, it's not, and there are different ways that investors think about it. But it's not often by industry specific. Preferred return, we've seen a range of anywhere from, call it 8 to 15%, probably clustering more in the 10 to 12% range right now. Step up, step up probably should vary more than it does. Because it really should be a sliding scale based on how much equity is actually, what the debt to equity ratio is in the deal. Not everybody is that. There are investors who take that level of sophistication. There are other investors who say, all right, I want a 2x step up, or I'm not interested. Anything less than a 2x step up, which it can happen, but it's less common to be in that 1.75, 1.8 range. That's not very common, and then it can go up from there. Right? We've seen some that are even 2.5 recently, but all of those terms kind of in flux constantly. So you're seeing this a year from now. Don't quote me on those numbers necessarily.
And on negotiating some of those numbers with investors, somebody asks, what are the negotiation levers that favor the searcher? I assume the go-to is always strength of deal. If you have a great deal, you have a better negotiating position. Anything else?
Yeah,
Anything
I think
non-obvious?
you had one of your in one of your webinars earlier when you had investors on, and one of them described it as a three-legged stool. Right? There's the searcher, there's the deal, the business, and then the deal terms. Right? So if you want to do better on the deal terms, right, make a better pitch about yourself, and then find a great business. Easier said than done, I know, but if you want better deal terms, if you can tell that compelling story to investors, or get, if you can have an auction situation where you're oversubscribed, right, then you can get better terms from investors. So yeah, sadly, it's just get as good of a deal as you can.
And I think the other thing here, and this is a really hard decision for a lot of searchers, is that there is, do I offer more to investors and potentially give up some upside that I didn't really have to give up? Or do I start lower, and then what happens if there's crickets? Because it's hard to go back to investors and say, hey, I offered X, but now I'm offering Y. And it can happen. There are retrades and stuff, but sometimes if you make an offer that is not very palatable to investors, the investors won't negotiate with you. They'll just say, no, pass.
Mm-hmm.
And then it's hard to come back. And sometimes you're like, well, I wish I could have filled out that cap table, if I had offered a little bit better terms to investors, and you don't even get feedback on that. So that's why I would say it is always a difficult decision. But if you're not getting the feedback that you like, the responses that you like, that might be the investors just kind of saying no and not necessarily even telling you why.
Yeah. And you could also, push harder on some of these economic terms in exchange for giving more on some of the non-economic terms, right? You could, when you're going to investors, you just say, all right, we're going to have this put, then it's going to be in there, right? You're guaranteed to get out. But in exchange for that guarantee, I want a little bit more, right? Incrementally, or around control provisions, or whatever, right? There's so many things that do get negotiated. It's not just the numbers.
A couple quick follow-up points on that, Bill, to your point about an investor saying just no thank you and not providing any further explanation. One thing that you as a searcher can do is just, if an investor declines you, is send that follow-up email and just be like, thank you, understand, hope we can work together in the future. Would you just mind telling me what it is about this deal that you didn't like or didn't want to do? You may or may not get an answer. Probably can't hurt. At Minds Capital, we make a point to, if we decline to invest in a deal, we make a point to tell them why, so that we can kind of help them in their further fundraising efforts. It's point one. Point two, I would say, is for searchers and sponsors out there, is you got to think about fundraising and raising money from investors as a market. You're going into the market, and there's supply and demand dynamics like in every market. So if you have something that's really valuable, you can command a better price, i.e., in this case, terms. So the stronger it is what you're selling, the three-legged stool, or the two legs of the stool, you and the deal, the higher the price that the market will pay, i.e., the stronger terms you can command from the investor group as a whole. So think about it that way. You're selling something when you're going out there, and the terms of that investors are investing in potentially is your price. Somebody asks about, so we're talking very much about third-party investors here, professional investors who are looking at their returns. Going back to the friends and family, though, are these pref rate and step up and stuff, is that offered to friends and family or not really? Bill, I think you said often they just are lumped into the common equity alongside you, the protagonist. Are they going to be cool with that? Like, you're giving them different terms. How do you negotiate that if they later learn that? How to think about that?
Yeah, I mean, I think there's two scenarios to think about. One is, what if you have friends and family and no preferred third-party investors, right? Because then it might be a little bit easier to say, okay, you're getting this many common shares, you paid it, you're on the cap table, you don't have to answer any awkward questions about why somebody else is getting you know, this nice preferred return and, you know, your Uncle Joe isn't. So I would say it really varies, depends on the sophistication of the friends and family and also how much they care about it, right? You can have somebody who's very sophisticated and cares very much, and he'll ask for all the same things that the third-party investors do. You could have somebody, frankly, who might even be sophisticated, but like they're so rich they don't care. They're your rich uncle. And so, yeah, sure, they'll just like toss you money. Or you might have friends and family that just don't understand finance and just think it's normal that if they invest 10% of the money that's used to buy the, you know, the deal, that they get 10% of the equity, never mind that, you know, you're using 80% leverage using SBA debt and seller financing. So they, you know, it's a little bit there. Now, in the event that you have friends and family and you have, you know, these other investors, then, you know, it depends. I mean, I will say investors do like to see you putting in your own capital, but that's just going to be like common. And I would say that, you know, it is common for them, if they are going to essentially bear the same risk, for them to get the same upside that the preferred investor would get. Does that mean you have to offer that to them? Not necessarily. But if you don't, then just prepare yourself for an awkward conversation if they ask like why they aren't getting preferred returns when they're taking on an equal amount of the risk.
Yeah. I'll just say, like, don't be too greedy. Like when you're doing this stuff, like, don't be greedy. They're your friends, they're your family. Don't blow up relationships over some of these points. Like you may be better off to just give them the same terms. Right? Because it's whatever. I don't think it's worth it sometimes.
Yeah. And guys, what about between and among professional investors? So leaving aside friends and family now. Say I have a great deal and I've set my step up at X, and there's just such a crush of demand to get in my deal. Mid fundraise, can I lower my step up to subsequent investors? And so they don't get, subsequent investors don't get as good terms as my early investors, because as I've done my fundraising process, I've realized that there's this enormous appetite for this deal. Or is that, what are the norms there, and frankly maybe ethics around that?
You would not be able to hide it in all likelihood.
Yeah.
Right. Because everybody's going to read the waterfall. And everybody's going to see the cap table, and so I'm not sure you'd be able to hide it.
Yeah.
Could you do it? Maybe. I don't know. We've not had that particular scenario yet among any of our buy-side clients, but
I think
it doesn't.
I think that usually the answer is you're happy that you're oversubscribed, and it's a lesson learned for next time that maybe you can be more aggressive. But if you go retrading, you are really endangering burning some bridges. So I think it's good. It pays to be long-sighted, and I would just be super happy that I'm oversubscribed if I was in that situation.
Yeah. Great. Okay, well, let's just distill this whole category of questions to, your investors are likely not going to like it if they are paying different terms than other investors, either between institutional professional investors or from your friends and family over to the professional investors. So generally, everybody wants to feel there's probably going to be some sense that some investor who got worse terms than another investor is going to have some sense that they were treated unfairly. So you probably just want to avoid it. And if you're more aggressive, you want to at least be able to know how you're going to handle that conversation. Cool.
Exactly.
Okay. Let's see. Some PG questions. What is the best way to structure a partnered search to avoid doubling up on the loan PG? Side agreement between the partners, different types of ownership, vesting, stock redemption, etc.
Yeah, I don't like side agreements. Side agreements scream to me.
Can you define that, please, James David? What's a side agreement?
A side agreement would be a separate contract that you're hiding from your lender in this context. And I can't advise that, right? I can't advise that people commit fraud on the SBA, whether it ever gets checked or not, whatever, you run that risk, but I just can't advise it. One of the ways that it's done is you can have the ownership separated from the economics. So this doesn't work in an S corp, but if you're not doing an S corp, you could have an LLC with kind of economics where the economics could be 50-50, even though the ownership is 81-19, right? In terms of the units, there are ways to do that. There could also be, sort of options put in. Is another way that sometimes people do this, where people have the option to buy the additional equity to make it even for a nominal amount. That sort of, and where that might come in is, all right, you pay down the SBA loan quickly. If you're not dealing with, it's easier, but so you can pay down the SBA loan to where that's gone now, and then, all right, here's a way that we can just even it up to what we wanted all along on paper, right? That only works for a long-term hold. Yeah, that's probably the cleanest way is if you're doing an S corp, you can't do it that way. As far as splitting the economics from the voting power, it doesn't work in the same way. Just with some of the restrictions of the S corp, you have to do other things, but it's probably most common to split the economics, which you would do for employees anyway, for example. Right, it's kind of what Bill was talking about with employees.
And keep in mind, right, you're almost certainly going to be using any cash flows to pay down the debt and not make distributions during the first couple of years. So the fact that one person only has 19% and the other one has 81%, you're not getting any more distribution because all the extra cash flow is going down to sort of paying down the debt. So hopefully if you structure that right, by the time you buy back in, you can also say, I have a veto right. Don't make any distributions until I get to exercise my call right, essentially. And then, you come in and you exercise your call right. You then have to, there are certain other things involved with that, but yeah.
On a step up, if to take your example, Bill, $1 million of a $10 million deal and a 2x step up, my $1 million just gets me to 20% of the economic value of that deal. Does that trip the PG for the investor? Go ahead.
Yeah, no, generally not. And investors will not be, you always have to structure stuff with the SBA and make sure that work with your lender to make sure that things aren't getting, too much of a problem.
At that size, you're also probably not dealing with SBA anyway, right? So
a lot of times
at the 10 million EV size. So
well, let's adjust the numbers down to make it SBA applicable.
Yeah,
$5 million deal, $500,000.
I would say talk with your lender about it to make sure that you're not tripping over that accidentally. Most of the time, most of the time you can find ways to structure it. Although it is true that if at the end of the day, they are writing a big enough equity check that they are getting more than 20%, 30% the upside, you might have a problem.
Yeah, and so what would happen is they'd split and invest through two different things or whatever in order to stay under the threshold. There are ways it can be done.
Yeah,
but investors are not going to want to sign a PG.
That will never happen. So sometimes, by the way, that can be a problem in seller rolls. There have been situations where the seller has wanted to roll like 30%, but then they'd be subject to a personal guarantee for the entire debt, even though they're just rolling. And so, there's had to be difficult conversations about that.
Guys, we've gotten a couple questions about the preferred return, which is right here on the slide too. Can you just give a 60 seconds review of exactly what that is? I think there's some confusion. Is that that's not the step up? That's not the IRR that you're selling the deal with. So can you give us 60 seconds again on defining it well, please?
Yeah, so basically you should think of it in terms of the waterfall in the event that there's a distribution. So let's say you have, again, the example, the $1 million, and they have a 10% preferred, return. That means that, year one, they get $100,000. Year two, it might be more than that because you can have some compounding. And so you go for, let's say, 5 years and you've built up, $500,000. It'll be a little bit more than that, but $500,000 of these preferred return that you haven't paid. So now you have an exit event. You sell your company, congratulations, this is the whole point. The first thing that you pay is that $500,000 of all that interest that has been accruing for the preferred return. Then you pay back the capital. So that $1 million. And then finally, you're distributing it out to everybody according to the number of units they have. That's where the step up comes into place. So a way to think about it is it's basically this return that the preferred investors get even before they get their capital returned. It's this interest return that they're sort of guaranteed.
Yeah, and it functions a little bit like a loan. Right.
Which is why you'll sometimes hear it referred to as kind of this hybrid vehicle. It's kind of loany, it's kind of equity.
It's effectively as if, their investor is giving you, or the preferred return is as if the investor capital was a loan.
Exactly.
And then they get the capital back, and then they still get the equity on at the lower level.
Exactly. Right. So investors are giving you money as equity, and you have to pay interest on that equity. So it's there feels like a double dip, but I'm sure that there's a good reason for it.
It's because investors demand it.
Because why?
Well, because investors ask for it, and if investors ask for it and everybody asks for it, that's the market. You just have to accept that. So
now, when a searcher is doing their model and they're showing like the IRR, base case, bull case, bear case, and they're showing you, investor, here the base case is 35% IRR. That IRR number includes all the money that the investor gets from preferred returns, from exit, from equity payback. So that's the kind of soaking wet number, which is why it's the headline number is the IRR, right?
And sometimes people will put in aggressive repayment of pref and repayment of principal into their model as a way to juice the IRR, and there are investors who do not like to see that. So like if you're doing the model, be careful around that particular thing, because that can really dissuade certain investors from being interested.
Why don't investors like that, James David? To see why wouldn't, as an investor, I want to get all my money back ASAP?
Yeah, we're if the investor wants to, often investors want you to keep the money in the business and grow the business in those early years as a way to potentially expand the multiple, to get multiple expansion on the back end when you exit, so that they would actually get a greater return in the end.
One way to think about, go ahead, please. Bill.
Well, I was just going to say, like, you're basically saying if you're very aggressively returning capital, like I cannot think of any possible way that I can invest this money profitably, so I'm just going to give it back to you, which it's pretty poor business opportunity if there's no add-ons anywhere. So.
Exactly what I was just going to say, and I'll just add the number to it. So if the pref in the deal is 10%, and I'm trying to just pay my investors back so I don't have to pay their 10% interest anymore, I am de facto saying I can't think of a better way to spend the money, your money, to get better than 10%. So my best capital allocation decision is to stop paying you 10%. Well, if you've bought a business where you can't think about anything to do with a dollar that gets you better than the pref rate, that doesn't get you better than the pref rate, you got bigger problems. That's a very weak signal about the prospects of the growth of this business.
Yeah.
The put option, guys. Somebody, Varick was at the same the investor panel that Acquiring Minds hosted some months ago, where we talked about the put option. James David, you referred to it. On the other, so put option, reminder everybody, where I as investor have the option at year X to just sell my interest back to you, the searcher. So I know that there's a way for me to get my money out. I just know that I have that as a backstop to get my money out. Don't have to, but is there a call option where searchers can force me as investor to sell my stock back?
It's not nearly as common. There are a few people who want it. It probably sends a bad signal, frankly, to investors if you're asking for it. Because from the investor perspective, all right, I don't necessarily want to be forced out of a winner.
Exactly.
Right. That's the only time the call right would actually be used, is if this is such a gangbuster success that, right, pushing them out at a pre-agreed formula because you can then sell at a higher multiple, so you capture more of that value. It's like, I mean, the investors backed you. They're going to want to, right, if you're able to get that multiple expansion, the investors want to get part of that. So it sends a bad signal, really, to even ask for it, and it will really anger certain investors. If investors do care about the put right, they maybe care even more about the call right. So
I'll state it more bluntly and strongly, which is I would never invest in a deal with a call. The whole point of investing is that there's upside. And if you, as the person I'm investing in, can just kneecap my upside whenever it looks like precisely, you'd only be incentivized to do that, you searcher, precisely when you think the company's going to the moon. Right at that moment is when it's logical for you to get my equity back. Then you've basically just put a ceiling on what I can do here, and every investment, the hope is that it goes to the moon. And so you're basically saying, like, no, I'm not, we're going to cap it. so it's not, and it might feel like, oh, but if it's fair for the I don't think that puts and calls are equally, it's not like, well, if there's a put, there should be a call, same. I don't think that's the right way, the right framework to think about them.
There are also some limitations on the put, right? It's not an open put. Right. So if the business is in trouble at the 5-year mark, right, the investor is not going to be able to, like, force you into bankruptcy through exercising the put right. There are limits on it. So it's not an uncapped thing either. Right. If you're, I've talked to a few people who are concerned about that. Like, there are some limitations on the put right. Your investors can't use it to cripple you. Just thought I'd add.
Great point. No, great point. Exactly. Does any of the preferred return paid contribute to the principal investment balance? No, it's interest.
No.
It's not.
If you really want to get technical, the thing that causes an unreasonable amount of fights, I say unreasonable, but lots of fights, is whether or not tax distributions count towards the preferred returns. Many investors feel very strongly that it shouldn't, because that tax distribution, they're just paying that onto the IRS. It's been a negotiated point in a lot of deals. I'll just put it that way. So.
Everyone, public service announcement. We're at the hour, so officially we're done, but we're not. We're going to keep going. Assuming James, David, and Bill that you guys can. I assume we have a few more minutes. We have a ton of questions. But ask your, as I said at the top, let me repeat, James, David, and Bill can follow up with you after the fact if your question doesn't get answered in these next 10 minutes. So feel free to ask it. These are all saved for us to use after the fact. And particularly if you got a hairy question, a particularly complicated question that I'm not likely to ask now, that's specific to a deal, maybe now would be the time to just put it into the Q&A, and James, David, and Bill can follow up with you on that question. But let's squeeze in a few more here. Business. Oh, do investors like to see that? What percentage do investors like to see the searcher put in? Skin in the game. So I'm buying a $5 million business, enterprise value $5 million. I'm raising $500,000 to $1 million for the down payment from investors. They're going to say, "What's my skin in the game?" What do you guys see out there as kind of norms?
Yeah, I mean, obviously, more is better from an investor perspective, but perhaps not necessarily in absolute terms, right? Because it could be that, you know, a searcher who's putting in a smaller absolute dollar amount is actually putting in a larger percentage of his net worth into the deal, and investors, you know, more sophisticated investors may be looking at that as a positive signal. Particular percentages being common, like it's all over the place.
I mean, I would say that, like, if you're putting in $250,000, like 5%, because if you have in a $5 million deal, if it's SBA, $500,000 means you could have just financed this entirely your own, right? And so, you know, if you're putting in a couple $100,000, that's, you know, for many people, that's like a very, very meaningful contribution. I think when you start getting into larger deals, 10 to 20 million, like the percentage starts to, you know, go down. You know, but, you know, you're putting in a $10 million deal. If you're putting in $500,000 of your own capital, I think investors would see that as a strong signal that, you know, you really believe in the transaction, and it can be a really good, valuable thing. So yeah, exactly, to echo James David's point, it really depends on your circumstances and the size of the deal as well. So
there's so many phrases that you hear commonly in our world that are often borrowed from private equity or VC sometimes, or venture land. And skin in the game is one of those cliches. But it really does capture something important. Your investors want to see alignment. They want to see that you have something at stake here, and that they're not the ones taking all the financial risk. So a sophisticated investor is not just going to look at the absolute dollar amount you put in, but how heavy that burden is on your own balance sheet. The more, the better, frankly, because it demonstrates alignment. You know, another word. They want to know that all of your interests are aligned, and that you are very much going to care about this transaction and are going to be the best steward possible of their capital. Sorry, James.
And there can be other signals too, right? In certain larger deals, there can be what's effectively a bonus to the sponsor for bringing the deal. So a certain amount of money that goes to the sponsor at closing as part of that transaction. And, you know, you can take that money out, or you can kind of roll that into the deal, right? So if you're, and this doesn't necessarily apply to searchers, but for sponsors, and I actually just put up an article on LinkedIn this morning about some of the, you know, that goes into a little more detail in some of these terms around independent sponsors specifically, although a lot of the things still apply to searchers. But, you know, if there is that sort of component of money to the sponsor at close, and the sponsor chooses to roll that into the deal, or to take that money in equity, right, that's another positive sign, right? The personal guarantee is another example of, you know, skin in the game, right? There are different ways to show skin in the game here. But as a rule, the more you can show, the better investors are going to respond.
And one other thing I'll just add is that, you know, really, if you believe in the deal, you want to be taking as little investor money as possible, because you're going to get fantastic returns, probably better than, you know, you're going to get basically anywhere else. And so, you know, if you were holding back on that, you know, it just seems odd, right? If you truly believe in the deal, like why would you not want to have that additional return? So just a thought.
Just put a link to James David's article on LinkedIn that he mentioned right there in the chat, everybody. So you can click that and read it. What specifically, the phantom equity story or two, what happened that it wasn't triggered? Can you expand on that for a minute?
So what happened in that case was the phantom equity was defined as the sale of the company in terms of sale of shares, and then the company was sold as an asset sale. And so it technically didn't trigger under the contractual right. And then, you know, but they sold the company, they just sold it in a different way. And they said, no, sorry, this agreement says if there's a sale of shares, there was no sale of shares. And we had to talk to them and be like, yeah, well, I mean, like it really sucks, but contractually, this thing has not happened. So, you know, but if they had actual equity, then they would be fully entitled to the proceeds, regardless of how the sale took place.
And that was a startup situation. And there are other ways phantom equity can be different, right? Phantom equity often, you know, if somebody leaves, right, it disappears, right? It just goes away if they're no longer employed. So you could have issues of, you know, you fire people right before a transaction. Not that that happens, but phantom equity just invites more shenanigans, and shenanigans invite lawsuits and potentially really angry employees. And like, you know, people generally want to treat their employees well, and there are just cleaner ways to do it.
Yeah. But the incentive for the searcher is, of course, that once you give equity, grant equity, even if it's vested, even if it's earned, you can never claw that equity back, really.
Under most circumstances, yes.
Yeah. I'm about to acquire a business whose key employee owns 3% of the company. What are some ways to structure this acquisition so that this employee remains in the business and is incentivized?
Yeah. So that, you know, if you can talk to the person, right? Because it's possible they want to cash out some of that, right? It's possible to roll that equity. For one, it's possible to cash it out. Could be a scenario where they want a combination of that, or they want a kicker of some kind for the transaction. It's also possible you could do some sort of, you know, earn in, right? Potentially give them more equity, or give them, you know, new equity to start again post acquisition. It's also possible that you just give them a retention bonus after a certain amount of time, as you might with other employees. But in some ways, it depends on whether you want to give that person money as part of the transaction. Because if you do, or if you don't, that shapes which option you choose. There are 4 or 5 different ways it can be done. But, you know, figure out, like, okay, what does this person need from me to want to stay? Yeah.
One thing I'll quickly add is if you are doing an asset purchase agreement for that transaction, then rolling equity becomes much more difficult, often just impossible. Not always, but so in those situations, let's say you want it to be an asset sale, then, you know, I would generally advise keeping the asset sale structure and then finding some way for them to reinvest the proceeds that they get into the business. You know, they'll have to pay taxes on it, so keep that in mind. But, you know, it's not the most tax efficient way to do it for that particular person, but probably is not going to override the benefits you're going to get from an asset sale. Anyway, another one of those talk to the experts type of situations, but something to keep in mind.
Here's something that will only apply to people having a successful run in their search business, but you hear about a lot. What happens to the cap table if you have a second round of investors come to the investment, but come in a different evaluation? So this would be a recapitalization, I guess. Yeah. So second round of investors, let's assume it's, you know, you've raised the initial money and it's 2 years later. Growth equity, I guess.
Yeah. I mean, hopefully it's growth equity.
Yeah.
Right. Down rounds are bad. I mean, what happens in that circumstance is you end up renegotiating the whole waterfall in many ways. And it will depend on where you are in terms of repaying the pref and repayment of capital of your original investors. Your original investors probably going to have to, they're going to almost certainly have a veto right over this transaction. So you're going to have to make them happy, right? It's going to be a 3-party negotiation. Hopefully, it could be more than that if you have splits in your investor group, but hopefully it's a 3-party, and you're going to just, it's going to end up being a different structure.
Usually what would happen in that situation is the investors are so happy that it's going so well that usually the growth equity tends to dictate terms. And so the growth equity will come in and say, here's what we want. And then you have a conversation with your investors who, if you've gotten them this far, often they trust you and are willing to kind of go along with it. But, you know, at the end of the day, they have those veto rights. So, you know, if you can't convince them, most of the time you can't do the deal.
Guys, one last question for you, and then we got to wrap up. But final call to the audience: if you're working on a deal, have some really specific hairy question, put it in now, and they'll follow up. James, David, and Bill will follow up with you. How often do you see general partner, limited partner, GP, LP structures in these small business acquisitions? And maybe just give context for that structure, which is obviously the private equity or real estate structure.
So we don't see that often, although you'll often hear terminology like that. So people, they say LPs when they say investors, they mean limited partners. Almost always now, we could have a history lesson, but the reason is that in the 80s when this was starting, it was much more common to have that type of structure, partnership structure. Nowadays, we have limited liability companies that offer almost all the benefits, but without a lot of the complications of a partnership structure. So nowadays, those are kind of legacy terminologies, GP, LP. From a legal perspective, they're not actually general partnerships or limited partnerships. It's all, you know, operating agreements. But if you are investing in a private equity structure or a venture capital structure, you'll hear those terms all the time. GPs are, you know, the private equity fund, the venture capital fund. LPs are the passive investors in those funds.
And it does happen in sponsor deals that we still have the fund structures happen, and in traditional search, right? It's common in some ways to have these, but for self-funded search, they're almost always going to be partnerships, you know, LLCs or potentially C Corp and shareholder agreements if necessary, and more even, you know, in sponsors, it's LLCs. It's not the GPLP sort of structure.
And I'll just also say we also will find that the terminology switches when you start getting into the fund structure. You'll hear things like carry percentage. So instead of like how much equity do I have, it's like how much carry do I have? And so it's funny. The finance world likes to make a new dictionary every time they come up with a new fund structure. So just be wary that certain items might turn around.
That's a great point. And it took some adjustment and now I use those terms interchangeably. It should be more specific, but yeah, for the audience, if you hear carry essentially means kind of equity ownership. GP means the searcher or sponsor, and LPs means your investors, people you raise money from. That's the loose mapping. So yeah, little key there. Guys, any final thoughts? Are we good?
I think we're pretty good. Thanks everyone for having us, and we're always, you know, happy to have conversations and have a discussion. So I hope we'll be seeing you guys as you start your search, or if you have any questions, just feel free to reach out.
Super. James, David, and Bill, thank you as always, guys. Fantastic panel. And don't forget, everybody, we'll have another one next month. It's already on the calendar, in our calendar. We haven't decided the topic, but I'm sure it'll be awesome. So watch for that. You'll be hearing from me about what it'll be. Thank you all. This ends the webinar.